I'm Howie Lim. This is Money Hacks by the Business Times.
Many investors gravitate towards familiar companies, markets, and sectors, often those they recognize and have followed for years. While this can feel reassuring, familiarity influences portfolio decisions more than investors realize, as allocations slowly become anchored to what has worked only in the past. Without regular reassessment, portfolios can gradually drift away from their original risk profile as companies and market conditions evolve. Spotting this drift in real time is often easier said than done. How can we tell when diversification is only superficial? And what signals suggest that hidden concentration may be building over time? How can investors identify and manage familiarity-driven risks in their portfolios? Welcome to Money Hacks. I'm Howie Lim. And we've got expert help today from Ritesh Ganeriwal, Head of Investment Advisory from Syfe, and Daphne Tan from CMC Markets.
Hi, Howie. Thank you for having me. Subtle indicators generally come through in shared drivers. So what drives the performance of the stock, not necessarily shared sector. So when we talk about shared drivers, what investors can ask themselves, would the same stress event cause a lot of their holdings to react in the same manner? So stress events could be a variety of whether interest rates rise sharply, tariffs are imposed, is China demand slowing? Would many of these holdings fall together because different industries still can share the same type of vulnerability? And the second thing they could also look at, which is also in the form of a question, how many of their positions are riding the same story? So if they're all riding the AI story or the green story or let's say the mining story, which is an interesting one, because when you think of mining, maybe you think of just gold, silver, rare earths, but then rare earths are also used in making batteries, which then could impact things like EVs. So are they riding the same story? Do they have the same impact when one of these stories get impacted by something in the stock market? Lastly, are all the returns dependent on future expectations or current cash flows? So if all of their holdings are a long-term bet, in which case it depends on when they're going to get out and whether that whole portfolio is sustainable for X amount of years. So generally, it's also good to have a mix of long-term type of returns and shorter ones.
This is a great question. And if you just look back a few years, 2022 was a perfect example where even though you're diversified across asset classes, geography, sectors, everything moved in tandem and the whole market had a drawdown. The details of your portfolio, it's not just about your sector and geography concentrations. What you really are trying to understand is the economic drivers of risk and return factors that would then influence your individual investments and holdings in your portfolio. Think of the current Iran conflict that is going on. You would think that, okay, if I'm diversified across sectors, maybe I'm not that badly impacted. But if you look at the value chain of, the oil industry, you would have the airlines being impacted, you would have the logistics companies being impacted, but at the same time, you might even have tech companies being impacted because the Iran conflict, it drags on. It can have implications on inflation and then on interest rates, and that can then drag down consumer-oriented sectors, etc. as well. So on paper, while you're diversified across these sectors, but these individual events kind of like unfold the hidden kind of correlations in the market. Similarly, if you extend it on the country side as well, if you look at Asia, you would think India, China, Japan, South Korea are somewhat different in nature in terms of their economies per se, and what are the core drivers of returns within these economies. But when you think about it in relation to the Iran conflict, the one thing common amongst these countries is they are all oil importing nations. And that basically means that if you have more concentrated exposures just in these names, then you are impacted negatively. So I think it's important to unlock what are the core underlying economic exposures that you have in your portfolio and what does it translate from a risk-return standpoint. At the end of the day, there are mechanics for you to think a little bit more intelligently about your portfolio allocations.
So we've established what the subtle indicators that reveal hidden correlation among diverse holdings are, but how should a long-term investor practically distinguish between a temporary market rotation and a fundamental shift in investment leadership when assessing their allocations then? Here's Daphne Tan from CMC again.
So what they can look at is what is actually driving the performance. Is it being driven by A, short-term macro conditions, or B, a longer-lasting change in trend, or where the capital is being allocated? So short-term macro things are like, let's say there's an interest rate cycle, or let's say because if we are in a growth type of economy, generally growth stocks would tend to come forward and lead the pack. Whereas if the economy is shrinking, in which case your defensives would step forward. So this would be more of a temporary rotation. Whereas if we're looking at a trend, a circular trend, so long-term trend. So, we had .com, and then we also eventually had AI. When AI first came, before that, there was a bit of a cloud computing. Is this going to work or not? But then after a couple of months and years, you realize that we are actually shifting into this entire new world where everything that is driven by AI or drives AI, it tends to do well. So in which case, that would be a change in entire circular trend, and that's where the capital is going. They can follow that for a longer term outlook as well.
I feel as though some aspects of what we're currently witnessing in the market are temporary, right, Ritesh?
There'll be short-term fluctuations in the market. And these tend to be more like valuation resets or a big market event or a sentiment change, some interest rate outlook changing as well. So these impact market in a more short-term manner and result in some rotation in asset class exposures as well. But these are not long-term trends that you need to worry about. These are not fundamental shifts that are happening in the economy. When we think about portfolio construction, we think of the long-term drivers of return for the different asset classes and the different building blocks of our portfolio. When you are looking at fundamental shifts, these tend to be driven by more structural factors, like your AI revolution that we are currently underway, which basically means that this is the next general purpose technology that is going to change the productivity landscape for us going forward. Big policy decisions, demographic trends, these are things that can have multi-year impact. And that's why when it comes to portfolio allocations, you need to think about strategic asset allocation, which takes into account that much longer time frame of your investments. So, for example, the leadership broadening beyond the US market, that is not just a short-term rotation shift. It's a leadership change and a fundamental shift because the earnings trajectory of the US market is more of a flatline kind of story versus the emerging markets in Asia. We are seeing accelerating trends when it comes to earnings growth.
Still to come. What are some most common yet often overlooked behavioral biases which lead us to concentrate risk in familiar assets? After all, we all have companies we like because of the products they make, but are they good investments? Also, what if we're concentrated already? I'm sure panic selling is never good. More with our experts in a moment.
Good conversations start with the right questions. This season, those questions are about us. The people, the policies, the forces shaping all of us. Lens on Singapore with Clarissa Montero. Back in May. Powered by the journalism of the Business Times. On YouTube and wherever you get your podcasts.
And now, back to Money Hacks from the Business Times.
Welcome back. We've been exploring why investors gravitate towards familiar companies, markets, and sectors with Ritesh Ganeriwal from Syfe and Daphne Tan from CMC Markets.
There are three, I would say, very common traits that are also very human. So the first big one is chasing winners because we want the large performers, the outperformers. But what tends to happen is that with these outperformers, they tend to all belong in the same basket. So as we have seen, you get acronyms like FANG, like Magnificent Seven, but all of them tend to be tech stocks. If somebody wants to pick all outperformers, they should maybe not try to look at just what's in the headlines. They can also look at outperformers in different areas, not just whatever's the biggest seven, because that would be consolidated in an index as well. That's what's leading the pack. They can make you a lot of gains. They can also turn into a lot of losses depending on what the situation is. Secondly, we also have investors sticking to one market. Geography, yeah, exactly. People tend to be more comfortable with home ground, or they, let's say, want to only invest in the US market because that's volatility and that's what moves. But the thing is, even if you do have many different holdings, let's say you have one healthcare, one tech, one semiconductor like manufacturing, but they're all in the same geographical market. If something happens to that market, what tends to happen is everything will go down at the same time for an unknown period of time, depending on the situation. And lastly, company-only investing. So this one is not really looked at because people tend to relate investing to buying businesses. Whereas investing can also mean going to ETFs, which are exposed to other assets, such as gold or even bonds. So a lot of people tend to step into this pitfall where I only buy businesses.
Ritesh from Syfe is taking his metaphors from nature and wildlife.
Trend following is something that we see a lot of. And in this present environment, there is a lot of like herd mentality. And especially on the retail investor side, there is this big social and media influence where they are swayed by what's the big talk in the market. And they get influenced to buy certain sectors and stocks, single securities, which in the present context might look great, but it can lead to over concentration in terms of their exposures that individual investors have. If you think of some of the other biases which are pertinent among Singaporean investors, there is this home bias as well. People love to invest into yield-oriented investments, especially REITs, bank stocks, and dividend producing stocks. They're just much more familiar, as you said. The other example that I've seen is if you're working in the tech industry, you tend to have a much, much higher allocation to technology companies in general as well. It is just a bias at the end of the day, because when it comes to overall portfolio allocations, if you have too much exposure into just the technology sector over the course of the last 5-10 years, technology has done incredibly well. But as we move to the next segment of the market cycle, there is value segments of the market that are starting to do much better. The tech sector is priced for perfection. So any miss on that side could lead to much bigger drawdowns. If you have very concentrated exposures to these names, the drawdowns that you will have will be on average much higher than other investor who doesn't have that concentration in these names as well.
Here's the big question then. What if we have an existing concentrated position in a successful stock? How can we gradually reduce that concentration without panic selling?
There is staggered selling. So they might sell a portion, let's say 50, 30, 20. So if the stock is doing exceptionally well, it's notching new high after new high after new high. At some point, investors, based on historical data, they know it's going to come down at some point, in which case they could go out by 50% and then reevaluate the rest, usually after that 30%, and they leave the last 20% running if they really have an attachment to that stock, or it tends to be a strong stock historically, in which case that's what they can do.
We have seen exactly these kind of examples as well. I have a few clients who are in the tech sector, and either they have company stock RSUs or they've just accumulated positions in certain names. So they are overexposed to these names, bringing that exposure to a much more palatable level. I wouldn't recommend drastically reducing that position at one go. They could trim it down in tranches over the course of, say, 12 months or so. As they're trimming, the proceeds can then be reinvested into a broad-based ETF rather than, again, taking another concentrated bet on another name.
And if the indices which are supposedly diversified are overweight in tech, think FANG and Mag 7, how diversified are they really? I'm talking about S&P 500.
That's a great question. And the reality is that, yes, market cap oriented indices actually are much, much more concentrated now than they used to be. So if you're just taking the broad-based index exposure, you might not be as diversified as you thought you would be. So S&P 500, the top 10 companies contribute 40% of the market cap. And it contributes 60% of the earnings growth that you're seeing for S&P 500 as well, or the performance of S&P 500 as well. What that means is if some of these companies or the sectors have cracks and there are earnings misses as we move forward, you are exposed to much greater drawdown risks than you would typically be in a truly diversified exposure. While this might sound a bit scary, there is plenty of choices in the market now. There are also other indices which are not market cap oriented. Value indices, you have small cap indices, equal weight indices. You can also diversify more internationally. So these are all tools that are available for investors to not just take the broad-based exposure, but be able to take these more nuanced, selective exposures that help them diversify in a much more true sense.
Money Hacks Takeaway Order 261 is up. Your familiar favorites can become your portfolio's comfort trap. Diversification means less shared risk drivers, not just different sectors. Don't chase the herd. Periodically trim your winners. Remember, true diversification is about economics, not just labels. And next week on Money Hacks, if you're feeling the itch to switch jobs right now before you hand in that resignation letter, there's lots you need to know. From tricky clauses in your contract to the best strategies to maximize your pay bump. We've got expert help, so stay tuned. A big thank you to Daphne Tan from CMC Markets.
Thank you for having me, Howie. Always a pleasure.
And Ritesh Ganeriwal from Syfe.
Pleasure to be here. Thank you.
Till next week, this has been Money Hacks by the Business Times. I'm Howie Lim.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.